With Trump putting tariffs on everyone and a global trade war starting, many European investors ask me, is ETF investing still a good idea? For the 17 years of my professional career, I've sworn by ETFs and index funds. I've invested hundreds of millions of euros in them. I even co-founded an index investing company, which now manages over 1 billion euros. Today, I am concerned that Trump's presidency creates a significant danger to ETF and index investors here in Europe. But this danger, it's not what everybody thinks. In this video, I will explain exactly what the danger is and how to avoid it. Okay, so when you buy an index fund or ETF, your money gets invested in hundreds of different stocks around the world. This is a really low-cost way to get a very diverse portfolio spanning many different regions and industries. Morningstar research shows that index funds and ETFs investing in American stocks got better results than around 90% of professionally managed investment funds over the past 20 years. But are ETFs and index funds a smart choice at a time like this, when Donald Trump is creating chaos in the market?
We may have short-term a little pain, and people understand that.
Critics say that index investing is dangerous right now because you can't avoid market crashes. When the market goes up, ETFs and index funds go up. But when the market goes down, they go down, and there's no way to avoid it. According to these critics, if you want to stay safe, you need to actively manage your portfolio and time the market so you can avoid the risks. Well, as it turns out, the biggest danger of index investing is tied to this market timing problem, but not in the way you might think. To understand it, let's look at the difference between time-weighted returns and money-weighted returns. When people talk about the fantastic results of index investing, they usually mean time-weighted returns. If I say that over the past 10 years, an ETF earned 10% per year on average, here's what that means. If I put 1,000 euros into this ETF 10 years ago and then held it for 10 years, doing nothing, while the market went up and down and up again, the final result would be exactly the same as if I simply earned a fixed, steady 10% return on my investment account every year. But in practice, investors are not automatic investing machines who just put money into an ETF and keep it there. Investors tend to invest more money when they feel confident about what's happening in the market and the economy. And they tend to invest less or even sell their ETFs and index funds when they get scared. Morningstar does an interesting research report called Mind the Gap. In this report, they compare the time and money-weighted returns of investment funds. In other words, they compare how much money a fund makes to how much money the actual investors in the fund make. And there is always a gap. Investors virtually always earn less than the investment funds which they choose. For funds investing in American stocks over the past 10 years, the average time-weighted return was 10.8% per year, but the average money-weighted return actually earned by investors was only 10% per year. So the investors in these funds earned 0.8 percentage points less. And here's the problem. In stressful times, this gap is likely to get bigger. Meet Anna, the ideal passive investor. She has a stable job with a good salary. And as soon as she gets her salary, she invests 10% in a developed world stock ETF. The rest of the time, she leaves her portfolio alone. Anna doesn't look at the market, she doesn't worry about the news, and she definitely doesn't buy or sell her ETFs or index funds depending on what's happening in the market. Now meet Bob, a more typical passive investor. Bob has read Jack Bogle's Little Book of Common Sense Investing. He knows about the benefits of passive investments. He also plans to just put money in a developed world stock ETF every month. But Bob also has a stock tracking app on his smartphone, and he reads the Financial Times. Every month he reads some concerning article that makes him worry. Is now really a good time to be buying more ETFs? 9 times out of 10, he manages to stay calm and keep investing. But every single month, he's basically making a new investment decision. Every time he's thinking, do I stick to my system or do I change? And here we come to how Donald Trump can really harm index investors. He's not going to break index funds or ETFs as such. Over the long term, index funds and ETFs are still likely to beat the vast majority of competitors. If you simply buy and hold like Anna, you will do great. But for individual investors, the presidency of Donald Trump is a uniquely dangerous time. Because Trump has mastered the art of creating drama. Every week, if not every day, he generates big headlines all over the world. For some people, these headlines are exciting. For others, they are scary. But in all cases, they provoke emotion. And every time investors get emotional, they are tempted to reconsider their strategy. For us passive investors, this is a real danger because our risk of timing the market and making mistakes goes up significantly. Here's how I deal with this personally. I acknowledge that I cannot predict the market or the economy, especially in the short term. And I remind myself that the powerful historical results of index funds and ETFs, they didn't happen because times were always great, because there were no problems in the world. Index funds and ETFs beat the vast majority of other investments despite all the problems in the world, despite the stagflation of the 70s, the Black Monday crash in 1987, the dot-com bubble, the great financial crisis, the COVID crash, and much more. And investors only got the full benefit of these fantastic results if they invested passively, without changing their strategy every time that things got stressful. So I commit to doing the same. I keep investing both when things are good and especially when things are bad and the market crashes. Now, the good news is, if you manage to do that, you are likely to do fantastic. Over the long term, ETF and index investing is very likely to grow your wealth and accelerate your progress to financial freedom. All you need to do is learn how to keep your cool and avoid big mistakes along the way. Now, if you'd like a bit of help staying calm when markets get choppy, you will love my newsletter for European investors. Every week I send out investment insights, money tips, and commentary on market news. So if you'd like to join over 70,000 other readers all over Europe, then follow the link in the description to sign up.